Imagine waking up to a sea of red on your computer screen. The headlines are screaming that $3 trillion were wiped out in a single afternoon. Your portfolio is bleeding, and it feels like your hard-earned wealth is evaporating into thin air. But have you ever stopped to ask the most important question in finance? Where did that money actually go? Did it physically disappear from the world, or did someone else just take it from you? The answer is much more surprising than you think. Understanding this one concept will completely change how you react the next time the market takes a dive. In this video, we are going to pull back the curtain on market mechanics. You will learn the difference between imaginary money and real money. We'll cover the high-speed pawn shop theory, the hidden reality of wealth transfers, and why some people actually get richer when everyone else is panicking. By the end of this video, you'll have a professional-level understanding of market cycles in under 10 minutes. Before we dive in, a quick disclaimer. This video is for educational purposes only and is not financial advice. To understand where the money goes, we have to stop thinking about the stock market like a bank vault. Most people think their brokerage account is like a savings account, but it's actually more like a giant, high-speed auction house. When a headline says the market lost trillions, it doesn't mean a bank was robbed. It simply means the perceived value of stocks has dropped. Think of it like your home. Imagine a realtor tells you your house is worth $500,000 today. You feel wealthy, even though that cash isn't in your hand. The next month, the neighborhood becomes less popular, and the realtor says it's now worth $450,000. Did $50,000 physically leave your bank account? Of course not. Nothing moved. The only thing that changed was the price someone else is willing to pay you right now. Stocks work exactly the same way. But here's where things get interesting. If the money isn't just vanishing, who is actually losing and who is winning? The most important concept to understand is the paper loss. This is a decrease in the market value of an investment that you still own. It works through market sentiment. If a company has 10 million shares and the price drops from $100 to $80, the market cap drops by $200 million. But that $200 million wasn't pulled out of the company. The crowd just decided the shares were worth less today than they were yesterday. The benefit of a paper loss is that it isn't permanent. As long as you don't sell, you still own the same number of shares in the company. The downside is the psychological toll. Seeing your net worth drop can lead to emotional decisions that ruin your financial future. This concept is best for long-term investors who have the stomach to wait for a recovery. However, there's something most people don't realize about the person on the other side of your screen. A market crash is essentially a giant, chaotic wealth transfer machine. For every person who panics and sells a stock at a low price, there is someone else buying it. When you sell your stock for $50 because you're scared, you are locking in your loss. That money is now officially gone from your pocket. But that money didn't disappear. It was handed over to a buyer who believes that $50 is a bargain. Think of a room full of people where someone yells, "Fire!" Everyone rushes for the exit, dropping their expensive jackets on the floor as they run. The people who get hurt are the ones who threw their jackets away. The winners are the ones standing by the exit with empty hands and deep pockets. They simply pick up the valuable jackets for a fraction of the cost. This is how institutional investors and savvy billionaires build massive wealth during a crisis. They aren't losing money. They are waiting for you to give yours to them. This is where many beginners get confused, especially when prices start falling faster and faster.
Sometimes, people are forced to lose money, even if they don't want to sell. This happens through a mechanism called forced selling, usually triggered by leverage. Professional traders often borrow money from banks to buy more stocks than they can afford. This is called buying on margin. If the stock price drops too low, the bank gets nervous about their loan. They issue a margin call, demanding the trader either add more cash or sell their stocks immediately. If the trader doesn't have the cash, the bank sells the stocks for them. This creates a domino effect. Forced selling drives prices down further, which triggers more margin calls for other traders. It's a terrifying spiral where the paper loss becomes a real loss against the investor's will. This is why using excessive debt in investing is incredibly risky. It takes away your ability to be patient. But if the money is leaving the stock market, where is it hiding?
During a crash, money doesn't just evaporate, it rotates. Investors move their capital out of risky assets like stocks and into safe assets. This usually means moving into cash, government bonds, or physical gold. The money is simply sitting on the sidelines, waiting for the panic to end. When you see the market losing value, imagine that value flowing into a giant waiting room. Institutional investors keep this cash ready to buy back into the market once the jackets on the floor are cheap enough. This is exactly what happened during the 2008 financial crisis. When Lehman Brothers collapsed, the S&P 500 plummeted. Trillions were lost on paper. Homeowners and banks were forced to sell at the bottom, but the people who understood asset rotation were waiting. They kept their jobs, kept their nerves, and bought the S&P 500 in March of 2009. They weren't just recovering. They were participating in one of the greatest bull markets in history. The money wasn't destroyed in 2008. It was handed over from the impatient to the patient.
To wrap everything up, remember these 3 key points. First, market value is just an auction price. It's not the same as the cash in your bank. Second, a crash is a transfer of wealth, not a destruction of it. You only lose when you sell, or when you are forced to sell because of debt. Third, money always rotates into safe havens before eventually flowing back into the market. The only thing you can truly control is whether you are the person dropping your jacket or the person picking it up. When the next crash comes, and it will, don't look at the red charts as a disaster. Look at them as a high-speed pawn shop where everything is suddenly 50% off. If you have the cash and the patience to do nothing, you'll be in the best position to succeed. If you found this explanation helpful, please hit the like button and subscribe to the channel. It helps us continue to create educational content that simplifies the world of finance. Thanks for watching, and we'll see you in the next video.